Welcome to the Treasury Update Podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to another episode of the Treasury Update Podcast. I'm your host today, Jason Campbell, Business Development Leader here at Strategic Treasurer. I feel very special to be a part of this because I've only been able to be on this type of podcast outside of the coffee break sessions a couple of times. So I'm really excited to be able to host today's session. With me today is Paul Galloway, Senior Advisor at Strategic Treasurer. Paul, glad to have you on with me today.
Yeah, thanks for having me on here.
You know, Paul, this is a great week of, this week of love. Valentine's Day is this week. Hopefully, I'm sure you got something plotted out for your Valentine as I make sure I do well for Valentine's Day for mine. And I think when we think about love and we think about gifting, and this is a good topic to kind of talk about today, which goes in what the Feds have gifted us all, a week ago with some interest rate hikes. The first one of 2023. I know that we came through out of 2022 with a few of these hikes already. And, kind of looking at, how does this impact, whether it's the start of 2023 or even down the road for 2023, and having this conversation with you around the interest rates and what these impacts are. And what I want to do is just kind of kick it off with, how do interest rates, I'd say, how do they change, but also those impacts to the changes. So let's start off with that.
That's a great question. It's fairly broad and open-ended, and we'll talk in generalities around, interest rate changes. The Central Bank of the United States, the Fed, has pronounced control over interest rates. So they set the tone. We experienced quite a few interest rate hikes in 2022. We started out the year the same philosophy. February 1st, they hiked rates 25 basis points, or what's known as a 0.25% interest rate hike. So what that means is that the interest rates that would be charged, and it's a target rate. So they're targeting, like a bandwidth of currently 4.5% to 4.75% on interest rates. And what happens is that treasuries that are issued, they're set in the benchmark, right? So it's a benchmark rate. The Fed sets that tone. And then when issuance comes out, it's issued within, that range, that target range. So 1 month yields, as I'm looking at right now, are hovering around 4.6%. When you look at 1 year yield, it's 4.86% roughly, give or take. These interest rates do move in the market. So the Fed sets the tone at benchmark rate, but market rates change. So as a treasury is issued, the yield on that treasury will move around in a given day. So it doesn't hold steady. It can be greater than or less than the issuance rate based on what's going on in the market. So the Fed has a lot of things to consider. And so when we were looking at last year, 2022, the glaring issue that the Fed was facing is inflation. It's the thing that the U.S. Fed is always fighting. They're fighting inflation. We don't want inflation to get too high, because what that means is that the economy is overheating. Prices are rising. Wages are rising. Employment is full, or what they consider to be full employment, and perhaps maybe a little bit more than full in terms of where it's sitting right now. So the Fed's trying to cool things down, because inflation gets really high. It means that your economy can overheat, and everything in economic terms becomes more difficult for people over the longer period of time. So keeping it at a more low controlled inflation rate, you used to target back in the day 3%. For a while, the Fed was targeting 2%. I think they're going to get down to that range over a period of time, but I think there's more interest rate hikes ahead of us. What the Fed's done is good because it will help control those economic factors that are overheating. However, they came out February 1st, raised rates 25 basis points, and a couple days later, employment numbers came out beating estimates by a wide range, and unemployment is now sitting at 3.4%. So going back to my comment earlier, we talk about full employment. Well, we're there and then some. When the Fed continues to raise rates, what they're wanting to do is to control the amount of employment out in the market, because we're actually overemployed right now, in essence, for lack of a better term. There's too much employment out there. Employers are fighting to get people to join their organizations because of lack of people out there in the market that are available. And so when we're in that environment, wages start rising to attract more people, which adds to inflation in the longer run, which we have not only this employment thing, but we have a lot of the things that are going on around the world, because the whole world is experiencing inflation. You look in Europe, inflation has been extremely high there. They hit a little over 10% last year. So their central bank is doing the same thing. They're raising rates. Even China's economy's been hit. They have had all kinds of different things that hit them because they're so integrated around the world now in producing products. And since everything else is getting hit, plus supply chain disruptions, COVID, war in Ukraine, there's a lot of factors that go into that. But we've had disruption in supply. We've had a world pandemic that is starting to subside, and now China has released their zero COVID policy, which now they're having to deal with the impacts of that in their country. So there's a lot of factors externally also impact what is going on there, and the Fed's trying to control all this. So it's global economic impacts, supply chain effects, prices increasing as a result of these factors, unemployment all-time low, wages increasing. They're fighting inflation. That's why we're raising rates now. One could say, is 25 basis points enough? Well, perhaps not. The Fed has a history of making these rate decisions where it's too much or it's too little. So they overcompensate or don't compensate enough. And it's very difficult because they're looking at all of these different factors, all these different measures. Sometimes they show conflicting information. Some will be, hey, it's heading the right direction, doing good. And others will be like, oh, this is not good. And a lot of this is historical looking. It all goes towards how the Fed views rates, what they're trying to control, which is inflation. So right now, we're in this increasing rate environment.
So, as you think about it, you mentioned a lot of great points and bringing in, not just the announcement of raising the rates by 25 basis points, right? But also too, then the jobs that come in and the global impacts. And man, I don't know about you, but I couldn't imagine trying to be an economic strategist, being in charge of figuring out, hey, your challenge is to curb inflation, right? And these different economic models. And it almost seems like you kind of mentioned, almost like this 25 basis point, will it do something? Will it not do something, right? And I think it's more so of each time that this, these interest rates do rise, it's watch and see, right? What type of impacts does it have, right? It's either going to have three different options, right? You're either going to have a positive impact, which is what we're looking for. You're going to have a neutral impact, which no harm, no foul, right? Or you have that negative impact, which then you got to have that recourse to that pullback plan and be able to execute something really, really fast to really try to push it back into the right direction and minimize the amount of damages.
That's spot on, Jason. A lot of factors that go into this.
You got to be almost the brain surgeon of economics, right? To kind of be, because not only domestically, you also got to think about from a global impact, and how does it impact other economies? As the U.S. dollar is how it's used on a global scale, and so there's a lot that goes into that, and you got to have all parties getting to agreeing that says, hey, this is going to be the right course. In the right direction. So when you were talking about, you brought in how many changes we had in the interest rate changes for 2022, and obviously the one that we just had at the beginning of February. Why do changes in interest rates matter? So why are we so glued to find out when you hear the report that the Fed is going to make an announcement, right? We're kind of glued to our media outlets and evaluating what occurs. So why does it really matter?
There's several factors or reasons why interest rate changes matter in the environment we're in now. Some of the most common factors that treasurers consider are what are the impacts to cost of capital. And so they got to consider that when they're thinking about their balance sheet or their liquidity position and their access to capital and liquidity. So interest rates rise. Inherently, the cost associated with issuing new debt or raising capital will increase generally. That's what happens. It increases. The other thing that also happens is that your liquidity or your cost to raise liquidity when you have times of stress or times of need or just general operating activity, use of liquidity tools to provide cash when cash is needed, that also increases. So your cost associated with that increases. Some of the other things for treasurers to consider, especially ones that have a global footprint. So if they have cash flows that are coming and going in local currencies, and when I say local currencies, could be, for us, local currency is US dollar, but they could have business in Europe. And so it could be, it could be Great British Pound, it could be the Euro, it could be in Asia, maybe it's Japanese yen, Singapore dollar. It's a different currency, and as there's changes in interest rates, and there can be an impact on your currencies. And so that's another factor for them to consider. So they think about, well, are there things I need to do to fine tune my hedging program for foreign exchange? Do I want to do that, or do I want to hold pat? When rates were being increased last year by the Federal Reserve, we saw that the US dollar, initially US dollar strengthened, and then we ended up, as other countries around the world started increasing rates as well, we saw that come back down. But there was definitely a shift in currency activity or volatility. I think we're going to continue to see some FX volatility, not only on the US dollar side, but also on local currency side. So those are factors that are pretty common with changes in interest rates, or things that I think treasurers will be considering as the Fed makes its decisions. This also impacts how companies or organizations continue to move their organizations forward. So it could increase the speed with which they're engaging in terms of new products or services, or it could slow it down just depending on what their strategy is. There may be good rationales to why they would do that. It may be, hey, we've got something that we want to do before things, the costs increase too much further. We're going to execute now. The other flip side could be, hold and wait pattern. And there's various reasons why they might want to do that. So it can also impact their decision making in terms of how they continue to grow the business, roll out new products, make decisions in terms of where they may enter new markets.
I guess it's the same thing we talked about with being an economic strategist and being able to kind of, look at different models to gauge how to move the economy and to keep it in the right side of things. And I think now, go back to it, you were just talking about this. Now all of a sudden I got to think about it from a corporate perspective, right? Like how much busier are those corporate executives, whether your chief financial officers or your investment folks, your treasury individuals, like how much busier do they look at their job or their role, their career in these past 12, 13 months, right? than what it was beforehand, right? Now I get it from a standpoint of going through the pandemic and, and still having the recovery side of things. But I would imagine as you were talking about, with cash flows and investing and where you're going to put, where the money goes, right? To get the biggest return or the safest spot it needs to go, or however that being able to juggle the right direction of your organization. I imagine that's got to be a pretty hefty job for this past year. I mean, I'm just getting curious on your thoughts on that piece.
I think it is. So I'm going to step back a little bit in time so we can think about going into when the pandemic hit. And what we saw with, and I'm just going to talk about where yields were on short-term cash. So this is everything, from 1 day or overnight to 365 days. And a lot of these things would be treasury bills, short-term bonds, prime funds, government funds, treasury funds, commercial paper. What we saw happen was that the pandemic hit, everything started collapsing on yields, in particular around tools that treasurers use on a common basis, the Govy treasury funds and prime funds even. Yeah, so these are short-term liquidity pools that earn yield on cash for treasurers, and they park cash in these vehicles quite often. And we saw a big movement of cash from prime funds to treasury funds or government funds because they're safer, right? So there was this issue around concerns around credit and preserving the corpus, for lack of a better term, or what people consider to be principal. So preservation of that so that you're not damaging the principal balance. So these treasury and government funds have fixed net asset values. Prime funds are floating. And so that means, it can be worth one today, but it could be worth less than one tomorrow. That's not the case with the treasury and government funds. So that's why they were making the move from prime funds to government funds. But what was happening at the same time is yields on these funds were declining. And the government funds eventually hit single basis points, like 1, 2, 3 basis points. You're hardly getting anything. Earnings credit rates that banks were providing to deposits in bank accounts fell down to 1 basis point. So you think of that, that's a single basis point is 1/100th of 1%. That's really nothing, right? So you're earning nothing on cash. Prime funds which typically outpace treasury and government funds by fairly significant margin also declined quite a bit. They got down into in some cases, some of these prime funds were in the single basis point range, 5, 6, 7, 8 basis points, which is just not something you normally see. So it became really challenging for treasurers to find opportunities to invest their cash and get a yield on it. With the rising interest rates, what happened? Some of this takes time to cycle through. So when interest rates are rising, it's not an instant thing to happen across treasury, government, and prime funds, or the earnings credit rate that treasurers earn on bank deposits. It takes time for those to rise back up. But we've seen over 12 months plus that those yields have risen. Now, at the same time, what we've seen with the Fed interest rate rises is we've seen the yield curve invert. So what I mean by that, a normal yield curve is what we call upward sloping, meaning that the short-term rates are lower than the long-term rate. So your 1 month, 2 months, 6 month, 12 month, year, 3 years, it's lower than 5, 10, 15, 20 year, 30 year rates. So it's upward sloping. That's what you would consider to be a normal yield curve. The yield curves today, because we've had all these interest rate rises, the short-term rates are outpacing the long-term rates. So it's like flipped. Why is that important? Because an inverted yield curve has predicted the past 7 recessions. And right now, we have an inverted yield curve. And so when you think about recession risk, it's real and it's out there, and it's very possible that we're in a recession and we don't know it yet because it's hindsight. And it takes time before it's officially acknowledged as a recession. A recession this year, I think, based on the yield curve and what we're seeing in economic activity here in the U.S. and abroad, it's a real risk. It's something that I believe we're going to see recession. Now, the question is what does that look like? Will it be mild? Will it be moderate? Will it be severe? I don't know. Time's going to tell as we continue to see more economic data come out. And so this kind of information is important to treasurers to keep an eye on because it can impact businesses. It can impact the access to capital, the cash flow of the organization, and to keep the business going. The treasurer's got to position not only the existing short-term cash, but it has to position liquidity pools correctly, access to capital correctly. So I think treasurers need to consider, what does the balance sheet look like today? Work with their CFO, get the balance sheet positioned correctly so that the business can continue to do the things that it needs to do as a going concern and position itself well to weather any storm that will be ahead over the next 6, 12, 18 plus months, however long potential recessionary effects will last.
To bring to a point too, and I think that's where, as we've gone through the economic crisis, that 07, 08, that problematic piece of that during that period. And as we came through even for pandemic and, trying to, still have some of that recovery still coming into play. And as we find ourselves in this water that we're currently in, I guess the positive side of things to look at is there's models to look at, there's case studies to look at. Technology can do a heck of a lot more with predictions and forecasting than it ever has been, right? So there's a lot of great resources and materials and studies to have that can help kind of know, like give you a better step into the right direction, right? So because as any organization, you want to stay clear of any negative impact, right? So you want to, how do you sustain? How do you still have some positive impacts moving forward? As you said, we don't know, right? We don't know when it's going to happen or what things will do, but it's all about making sure that we're making the strategic decisions, right? So you take the data points and the current economic landscape, and you put all those factors into play to make the best decision, for any organization and shareholders and alike. So as you could give some different, I don't want to say different, but continuing forward with that last statement you made about the future, right? And that's really what we want to look at. So how do treasurers position themselves to be in the very best position for the future?
Yeah, that's a great lead-on question to kind of where the discussion was going. So I talked about cost of capital, liquidity, access to capital. I think these are all factors or concerns that a treasurer probably has today. They aren't the only ones, but when we think about decisions around how the balance sheet is positioned, the liquidity or the access to liquidity, I think treasurers got to look at what levers they have in place today. They need to work with their banking partners on potential options that they could do. So, kind of a traditional capital raise that people might think of for an organization would be senior debt or some type of bond that's issued, debt instrument of some kind. And another one might be that an organization issues equity. We've talked about on some of our podcasts in the past, follow-on equity offerings. They could do that as well. I think treasurers today might want to look at alternative options such as like contingent capital facilities. And so what this is this will allow a treasurer and CFO of a company to access capital at some point in the future based on predetermined terms. And so they set everything up today, but they agree that, hey, you're going to access this capital, but you're not going to access it today. You're going to access it down the road. And what that can do for an organization is it can lock in the access to capital, and it can lock it in at a particular rate. These can be fixed or floating. And so I say fixed or floating. That means that the benchmark rate can be fixed based on treasuries. It's a typical fixed rate benchmark that's utilized. Or it can be floating. In today's environment, it used to be LIBOR that was used quite often. In today's environment, we're seeing, since LIBOR has gone away, people are using SOFR, which is a U.S.-based alternative overnight funding rate. And so SOFR is floating. It moves around over a period of time. So that benchmark rate is not always the same. The one thing that the two types of ways to set interest rates or lock-in rates where it's similar is around the credit spread. And so we didn't talk about credit spreads earlier, but this is an important factor to consider because as we move into interest rate hike environments and recessionary periods, what happens is that credit spreads tend to widen. And so an organization's credit spread will increase over time in times of stress. So this can be general economic stress, or it can be stress for the organization. So if the economy is stressing, it doesn't always mean that that's the case for every organization, but there are certain organizations that will feel the stress as well. And so that can stress their cash flows and make the credit a little more riskier. And so their credit spread can widen. Well, they can lock in that factor by engaging in these types of structures. So they can lock in access to capital. They can choose to not lock in access to capital today and take the risk that, come down the road, they need to raise capital. They might not be able to access it. In the same respect, they can think about liquidity in the same way. They can work with their banks to set up facilities. Revolvers are a great way to set up, or letters of credit to set up access to liquidity when there's time of need. These are things that you can set up and you draw down on, but you turn around and repay them. And so the revolving mean, I draw down, I use it, I pay it back plus interest. And so these are good liquidity tools for organizations that are beyond just the assets that they have on their balance sheet, which could be investments or cash. The other factors that treasurers are going to be concerned about are around the economic items that we kind of talked about earlier. Slow down the economic activity, what the impact is to the organization. They have to consider that. Like I talked about earlier, some organizations will feel more economic stress in recessionary periods or periods where inflation or interest rates are rising. Jobs are another factor as well. Wages, we've seen, wages have increased over this inflationary period. Jobs are still at an all-time high, meaning we're, what I would say is overemployed, is kind of the term I used before. I don't know if that's a technical term, but it's.
You can make it a technical term. It's fine. Yeah, we'll call it.
Yeah, it's a term to kind of describe, hey, we're full employment and then some. The other piece is the general economic factors that are out there. So treasurers have to think about these different factors and how it impacts their organization, what it means to liquidity, access to capital, cost of capital, the future cash flows of the organization. So they can be impacted by all these items that we've been talking about.
I think it goes back to, kind of almost you're preparing for, any type of storm or just, a trip or anything like that, right? It's you got to plan, you got to prepare, you got to make sure you have the right tools. And if you don't have the right tools, that's a good time to go get the right tools, right? There's plenty of options out there to ultimately, when you come down to it, have a game plan in place. And when the time is right, you got to execute it. And having all parties that understanding what that game plan is, communication is key. So, I think that's you made some really, good valid points, and hopefully our listeners out there were able to take some really key nuggets out of what you just spoke about. So, well, Paul, it's been a pleasure. Again, I always love speaking with you. And it's great because, being on the Treasury Update podcast, being a special guest today makes me feel very special. So, and always a pleasure speaking with you. And to our listeners, again, thank you so much for listening in. We really do appreciate it. And we look forward to having you listen into our next Treasury Update podcast. Until then, enjoy. Have a great week. Talk to you soon. Take care.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.